My name is Robert Promisel. I'm one of the portfolio managers at Resolution Capital for the Ned Investments Global Property Fund. Pleased to speak with you today about the December quarter 2023 results. Global REITs had a strong quarter in the December quarter, increase over 15%, exceeding global equities. It was a solid year as well, although it did trail global equities performance. In the quarter, all the property sectors and major markets provided positive returns, driven first by self-storage properties, up about 23%, retail properties, 19%, and industrial properties up 17%. Regionally, Greater Europe, comprising continental Europe and the UK, rose about 26% combined. The US was up just over 15%, and Australia was up just under 15%. We had a strong rates rally in the fourth quarter. It's now moderating somewhat. There's limited direct market evidence in the real estate market. We expect actually the number of transactions to increase in 2024 as the financing environment stabilizes. We've had strong operating conditions, balance sheet strength for REITs, very strong, good capital structures for the group. We look at the performance over past several years. You can see how the fund has done, how the overall market has done with positive returns. In terms of drivers of performance in the fourth quarter, storage really was an outperformer, driven by overweights in Big Yellow Group and Shurgard Storage. Big Yellow is the brand leader for self-storage in the UK, and Shurgard is the largest owner of self-storage in Europe. Data centers and towers were strong, and American Tower, which is one of the largest REITs, had very strong performance in the quarter. The diversified grouping also contributed to positive relative performance that included exposures, overweights to British Land Group, as well as Mitsui Fudosan in Japan. We also benefited by avoiding some of the more problematic Hong Kong-listed companies like CK Asset Management and Wharf REIT. On the detractor side, residential U.S. apartments they weren't down as much as they were just sort of flattish, and that was due to supply concerns coming on the market. We look at sector positioning. You'll see that data centers and towers remain a strong overweight for the fund. Very constructive outlook there. Also, healthcare, driven by seniors housing, is an overweight. Retail is really driven by necessity retail. Strong leasing activity in necessity retail, and the consumer is proving to be quite resilient. Industrial remains an underweight, as you can see. Very constructive on logistics longer term, but currently we're seeing a moderating leasing environment, and vacancies in some of the key U.S. markets are on the rise as supply, a little mini surge of supply comes in, and demand is a bit softer on we think, a temporary basis. We've talked before about economically relevant real estate, and this is really how the portfolio is structured. So residential, U.S. residential in particular, we have demand exceeding supply in the medium term and the long term. Very stable operating outlook. Data center and towers, we expect to see the continued digitization of the economy. We expect there to be more impact on leasing from AI in the coming years. On healthcare, it's really about demographics driving demand for seniors housing. Logistics is going to be, leasing is going to be driven by the efficient movement of goods distribution, increasing inventories that are being carried, and onshoring, which is really driving activity. And then retail, as we talked about, is really necessity retail. Regionally, the U.S. remains the largest exposure. It is a very well-diversified market with good transparency, and the REITs have strong capital structures. Japan is an underweight on the other end. That's because the fund has virtually no exposure to J-REITs, which are an important part of their market. J-REITs are externally managed, and they have little internal growth. Uh, you can see the top 10 positions, very much a large cap, liquid portfolio. You can see the U.S. representation along with Mitsui Fudosan in Japan, and then Link REIT, which is necessity retail in Hong Kong. The operating environment is really quite solid. Occupancies, as you can see on the left side, are at high levels. And then looking prospectively, supply is not a widespread issue as it has been for real estate in the past. And in fact, in the past, call it 9 months, we've seen this start to tick down dramatically. And so we expect there to be less supply pressure over the coming years. As a result, REIT incomes are demonstrating good internal growth relative to inflation. They're doing what they should do, and they're absorbing inflation, and that's really quite a positive. You can see that higher replacement costs, they've soared really in the past couple of years. That's had a few beneficial impacts for existing landlords. One, it's curtailed competitive new supply. There's just less construction activity going forward, and it also underscores the need for higher rents to support development. So the developments that are happening are achieving a higher rent. That's really to the benefit of existing landlords as well. I've talked earlier about capital structures for REITs, really very sound. We've seen leverage decrease over time. It's become very well managed in terms of laddered maturities, majority fixed rate debt, multiple sources of debt capital, including in the U.S., where many of the REITs have obtained investment grade ratings and have tapped the unsecured market. It's interesting, after many years where REIT performance and global equity performance tracked each other quite closely, they began to diverge in the pandemic, with global equities powering ahead and REITs trailing behind. We think that this is unlikely to continue and represents an opportunity, and that's really backed up by where REITs are trading relative to direct assets. You can see this chart here shows REITs relative to net asset value, and they're not at the lowest level they've been at, but they are at the lower end of what is a reasonable band. And so we think that REITs provide good, attractive value compared to direct assets. If we just start talking about some of the thematics again in the portfolio, really data center and tower, the digitization we think is going to continue. We're in the midst of strong structural growth as more and more economic activity happens digitally, and all of that has to be stored physically in data centers. Equinix is the largest position in the portfolio. It's the largest owner of data centers globally. It is very well positioned in major markets around the world, and importantly, over half of its customers are in multi-regions with that company. So we think that Equinix is very well positioned going forward. Healthcare, again, it's really about seniors housing. I talked about demographics driving demand. You can see on the right chart in the U.S., and this is true for Canada and the U.K. as well, where we have exposure. The over 80 age cohort is expected to grow at a significantly faster rate over the coming decade than it has over the past decade, and this is going to lead to, we think, structurally higher demand for seniors housing. It's happening at the same time that net inventory growth for seniors housing, see the chart on the left, has dropped dramatically, and this portends for a very strong operating environment for seniors housing. Welltower is the largest owner of private-pay seniors housing in the U.S., one of the largest positions in the portfolio. We've also added Ventas, which is the second largest owner of seniors housing in the U.S. Both companies also have exposure to Canada and the U.K., where the demand and supply trends are fairly similar. Um, if we look at residential more broadly in the U.S., rental housing really benefits from many years of there being under construction, if you will. There just hasn't been enough housing developed in the U.S. relative to demand. It also benefits from reduced housing affordability that we're seeing. Higher interest rates have really impacted the ability of people to purchase homes. That's kept people in rental housing, whether it's apartments, whether it's single family rentals, or whether it's mobile homes. It's just kept them in rental housing longer. Um, Invitation Homes is the largest owner of single family rental housing in the U.S., an important part of the portfolio, and is seeing rent growth that exceeds inflation. Unite Group, just to go further afield and to demonstrate illustrate just how diversified this portfolio is. Unite Group is the largest owner of purpose-built student housing in the UK. And we are seeing very strong university-driven demand for student housing in the UK. In fact, we think the Unite probably is tapping on the brakes as to how hard they can push rates in the UK, and we expect them to continue to be able to drive their income above the rate of inflation over time. Looking out for global real estate securities, we think that REITs have they're really in a very strong position relative to the real estate market overall. They have great management teams. They have very large operating scale, and they have good access to capital. Stepping back for real estate in general, we think the supply outlook has gotten to be quite supportive. With the decreased level of construction starts that we've seen in the past year, the regional banking crisis, certainly in the U.S., has impacted the ability of lenders to lend for construction activity. So we expect that the supply outlook to become much more benign over the coming years than we've seen in many years in the past. Capital structures for these REITs are very strong. Outside of a few select areas in continental Europe where leverage is a bit high, and in New York City where some of the companies are carrying too much leverage, REITs in general are very well capitalized, better than they've been almost any time in their past. And it's really unlike what you would expect from real estate more broadly, where you see leverage levels much higher. So that provides a lot of flexibility for REITs. It means that their cash flows are de-risked. And it's important in an environment where we see rates that are going to be a bit higher. And then finally, we think that REITs represent very attractive value relative to real estate overall. With that, I want to thank you for your time.